South African chemicals and fuel producer Sasol reported that interim core profit tripled, boosted by a surge in crude oil and chemicals prices. Mining productivity fell 16%, with its SA operations experiencing a number of incidents. The company decided not to declare a dividend. I spoke to CEO Fleetwood Grobler about the highlights of the past 6 months. Have a listen.
I think our business performed very much with the macro environment in support. We've seen a 62% increase in the average rand per barrel Brent price of crude and a 49% increase in the average chemical sales basket pricing. And of course, this did help us to post a significant increase in our EBIT number, which has increased 12% from the prior reporting period, as well as our adjusted EBITDA level, which has increased 71% to 32 billion rand for this past 6 months.
Take us through the operational challenges that you're seeing in Secunda that resulted in those lower production volumes.
So as we've indicated towards the end of last year, that we had some challenges that impacted our production volumes. It did start with our coal to fuels value chain in Secunda, and it basically is the underpinning reasons for that were we have implemented in the course of last year a full calendar operating system in our mining operations. And of course, the benefits of that full-co system was very much enticing and clear to us, and we still think that is an initiative that will unlock a lot of value. And whilst we implemented that big change program in terms of full-co, we also had some other aggravating situations that impacted on our ability to produce. Not only were those, we had significant safety-related incidents in our mining value chain. We had also been impacted by excessive rain towards the latter part of last year. This not only impacted our operations, but also our suppliers of coal that we rely upon. And the culmination of all of those factors impacted our production volumes, which we have indicated to the market on the 14th of December. But since we have taken all of those into account and put short and medium-term plans in place, we are currently tracking our guidance. And as we've indicated as part of this results, we are on track to deliver our range of volume out of Secunda to be between 6.7 to 6.8 million tonnes of production.
To what extent is the ways to mitigate some of the issues at Secunda impact your Sasol 2.0? Or how do you intend to, deal with some of the issues that are happening on that front?
Yes, the Sasol 2.0 program is a program that plays out over a period of 4 to 5 years since its inception. The ultimate value that we have set the targets for will realize in financial year 25. As we look at the opportunity for value, underpinning business recovery, that will be prioritized over Sasol 2.0 interim targets. So, for example, the targets we've set for this financial year to reach a certain level of fixed cost, I think we're tracking well on that to deliver the 3 billion we set as a target. But on the gross margin, our target we set for 1.5 billion rand, we are tracking around 500 million rand. And therefore, we believe that that may be reprioritized in FY22 and FY23 because the value of business recovery to the baseline would add much more value compared to this interim Sasol 2.0 target. But we still believe that the targets that we set for FY25 for 2.0 are solidly intact, and we are progressing to deliver that as we have indicated to the market.
You've resolved not to restore the dividend. What needs to tick the box for you in order for you to believe that you can do so on a sustainable basis?
Yes, we've already indicated last year to the market and also at our Capital Markets Day that we would like to see a balance sheet that is sustainably at a level that we believe is the right time to trigger a dividend. To this end, we indicated also that our net debt needs to be consistently below the $5 billion and that our net debt to EBITDA needs to be consistently below the 1.5 times. Now, we've made good progress, so we ended this 6 months with a net debt to EBITDA ratio of 1.3, but our absolute net debt is still higher than we want it to be. So I think we're nearing that now. In the next period, we may see that we get below that threshold that we've set for net debt, and it is contingent upon our business performance for this next 6 months, as well as the last 2 or 3 divestment parts that we have to now finalize, which are subject to some regulatory approvals that is ongoing as we speak.
Speaking of the next 6 months, what will you and the team be focusing on from a business outlook point of view? And perhaps you can touch on a little bit on the recovery plan for the SA operations.
I think that's so important for us at this point in time. The first thing, the bedrock that we have to deliver from is a safe and operational discipline mantra that we have to start and focus from. This is absolutely important for myself and the management team, is to have a bedrock of safe and disciplined operations in terms of delivering all our products and our production and our mining activities in a safe and sustainable manner. So that's our first focus. The second area is around how do we recover the business baseline through all our various program initiatives. And that is for us also very important right now is the recovery of the baseline. That means to bring up the volumes out of our coal to liquid mines, to bring up the productivity in that regard, and to increase the output from our Secunda operations value chain, as well as all the other chemicals affected production sites like Sasolburg in that gambit of the South African value chains. And so that is for us a key priority. And then, of course, we still have to progress our ESG roadmap in terms of our commitments that we've made, and we are making good progress there to reach the interim milestones leading up to the 2030, and that will remain a key focus for myself and the management teams.
That was Fleetwood Grobler, the CEO of Sasol. That is it for me.